The small daily money decision that quietly separates the rich from everyone else. Two people wake up on the same morning, same city, same age, roughly similar incomes. They both check their phones, they both have a coffee, they both go about their day making small, ordinary, unremarkable financial decisions. The kind of decisions that feel too minor to think about carefully, the kind that don't feel like decisions at all. 20 years later, one of them has meaningful wealth, a paid down home, a retirement account that has started to feel real, a financial cushion that changes how they make decisions because they are not making decisions from a position of scarcity. The other person is more or less where they started, not because of a catastrophe, not because of a bad investment or a medical emergency or a job loss, just because of the accumulation of 2 decades of small daily choices made on autopilot. And the difference between those two people is not income, it is not intelligence, it is not discipline in the way that word usually gets used as a kind of moral virtue that some people have and others lack. And it is a single structural difference in how they relate to money at the moment of decision. And that difference is almost invisible, which is precisely what makes it so consequential. Here is the uncomfortable truth that this video is built around. Wealth at the level most people are trying to reach is not primarily built through dramatic financial moves, not through stock picks, not through entrepreneurial swings, not through inheritance or luck or being in the right room at the right time, though all of those things happen. For the vast majority of households that build meaningful wealth over a lifetime, the mechanism is quieter and more mundane than any of that. It is the systematic, habitual difference between spending money reactively and deploying money intentionally, between financial decisions made in the moment under the influence of convenience and emotion and the immediate environment, and financial decisions made in advance according to a prior commitment that doesn't require willpower in the moment because the decision has already been made. That is the small daily decision, not a single choice, a mode of choosing. And the data on what it produces over time is genuinely striking. Let's start with the baseline math that makes all of this concrete. The median American household income is approximately $74,000 a year. After taxes, that's roughly $58,000 in take-home pay, or about $4,800 a month. Studies of household spending consistently find that the average American household spends somewhere between $200 and $400 a month on what researchers call discretionary consumables. This is the category that includes convenience spending, impulse purchases, subscriptions that are barely used, food and beverage spending beyond planned meals, and small transactions that individually feel trivial. Let's use the conservative number, $200 a month, $2,400 a year. If that $2,400 annually were instead invested in a diversified index fund, earning the historical average market return of approximately 7% after inflation. Here is what happens over time. In 10 years, roughly $33,000. In 20 years, roughly $98,000. In 30 years, roughly $227,000. From $200 a month. From the money that currently evaporates into the background noise of daily life so quietly that most people cannot account for where it went when they look at their bank statement at the end of the month. That number, $227,000, is not retirement. It is not financial independence, but it is the difference between having a meaningful financial cushion at 55 and not having one. It is the difference between choices and constraints. And it came entirely from the gap between reactive spending and intentional deployment of a relatively small amount of money. Now let's go deeper into the psychology, because the math is the easy part. The reason this gap persists across decades for most people is not ignorance of the math. Most people have seen the compound interest chart. Most people have been told to spend less and save more. The reason the gap persists is that our decision-making architecture around money is almost perfectly calibrated to work against long-term accumulation. Here's what actually happens at the moment of a small financial decision. You are at a coffee shop. The line is short. The drink is $6. You have had a difficult morning. The barista is friendly. The environment is designed with considerable sophistication to make the transaction feel pleasant and the product feel like a small, reasonable reward. In that moment, your brain is processing the decision in what psychologists call System 1 mode. Fast, automatic, emotional, context dependent. The $6 does not feel like a compound interest calculation. It does not connect in any felt way to the $227,000 figure. It feels like a $6 coffee decision. And $6 is nothing, obviously. Now, multiply that mode of decision making across every small financial choice in a day. The lunch upgrade, the app purchase, the subscription you don't cancel because canceling requires navigating 3 menus and you'll do it later. The Amazon purchase that arrived in the cart somehow. The round of drinks you bought because the social context made not buying them feel awkward. None of these are failures of character. They are the predictable outputs of a decision-making system that evolved for an environment where scarcity was immediate and visible, not abstract and future-facing. Your brain is extraordinarily good at responding to present conditions. It is mediocre at best at weighting distant future consequences against immediate present ones. Wealthy people are not immune to this. They are not wired differently. What many of them have, and what the research consistently identifies as the actual mechanism of their advantage, is a set of prior decisions and systems that remove the small daily choices from real-time deliberation entirely. This is the mechanism. This is the thing that actually separates the two people who woke up on the same morning. It is called automation, pre-commitment. The technical literature uses various terms. The practical reality is simple. When money is moved automatically to savings or investment accounts before it touches a checking account or a spending interface, it is never available for the reactive decision. It never shows up in the mental accounting that governs daily spending. The decision was made once in advance in a calm, deliberate state, and it executes itself every month without requiring willpower, attention, or real-time restraint. The behavioral economics research on this is unambiguous. People who automate savings consistently save more than people with identical incomes and stated intentions to save who do not automate. The intention is not the variable. The system is the variable. Richard Thaler and Shlomo Benartzi's Save More Tomorrow program, studied in real workplace settings, found that employees who pre-committed to automatically increasing their retirement contributions with future raises before those raises arrived and became mentally available for spending accumulated dramatically more savings over time than control groups. The money never felt like income. It was gone before the brain could spend it. This is not a trick. It is a structural acknowledgement of how human psychology actually functions and a workaround built around that reality rather than a demand that people overcome it through sheer force of character. Now, here's where the story gets more structurally uncomfortable. The consumption economy, the one you live inside every day, is specifically and deliberately designed to capture the reactive spending that automation roots around. The subscription economy is built on inertia. Companies have extensive data showing that a significant percentage of subscribers continue paying for services they do not actively use because cancellation requires action and continued payment requires none. The default is the revenue, Netflix, gym memberships, software subscriptions, streaming services. The business model, in many cases, explicitly depends on the gap between what customers intend to use and what they actually use. Amazon's one-click purchasing, introduced in 1999 and patented specifically because it reduced friction in the buying process, was a landmark moment in friction removal technology. The insight was not that people wanted more products. It was that people wanted products at the moment of impulse, and that every additional step between impulse and purchase was a step where the impulse could fade. Remove the steps. Capture the impulse. This is now the design philosophy of an entire industry. Food delivery apps, with their late-night accessibility and algorithmically curated suggestions and one-tap reordering, are not primarily selling food. They are selling the removal of friction from impulse eating decisions. The margin is higher than the restaurant margin specifically because the convenience premium is what people are actually paying for. Every one of these systems is on the reactive spending side of the equation. They are technologies for capturing money before intentional behavior can intervene. The automation strategy, the pre-commitment to savings and investment before spending, is the only consumer level defense against an industry that has spent billions optimizing for the opposite outcome. Let's talk about what this means at the level of a lifetime. Because the individual decisions are almost trivial and the lifetime accumulation is the opposite of trivial. The Federal Reserve's Survey of Consumer Finances, published every 3 years, consistently shows a striking bimodal distribution of household wealth. There is a large population of households with very little accumulated wealth, even among households with middle class incomes across their working lives. And there is a smaller but significant population with substantial wealth, often without dramatically higher lifetime incomes. The differentiating factor, isolated from income, inheritance, and investment returns, correlates strongly with savings behavior measured over decades. Not savings rates in any individual year, but habitual, persistent, automated savings behavior maintained across the ups and downs of a financial life. The households at the bottom of the wealth distribution for their income level are not there because of spending on any particular category. They are there because of the cumulative effect of reactive allocation of money over decades. Money arrived, the environment made claims on it, the money left. Consistently. Without a counter system that moved a portion of it, somewhere the environment couldn't reach, the households at the top of the wealth distribution for their income level built their position, in most cases, through the same mechanism in reverse. Money arrived. A portion was moved automatically before the environment could make claims on it. Over 30 years, the compound growth of that portion became significant. Same income, different system, different outcome, almost entirely predictable in retrospect, almost entirely invisible in the moment. Here is the irony that the personal finance industry obscures rather than clarifies. The industry is enormous. Books, podcasts, courses, apps, advisors, influencers, YouTube channels, including this one, generating billions of dollars telling people what to do with their money. The advice is often accurate. Spend less than you earn, invest early, diversify, use tax-advantaged accounts. Most people who consume this content do not materially change their financial outcomes, not because the advice is wrong, because advice, even accurate advice, delivered into a real-time decision-making environment does not change the architecture of that environment. You can know exactly what compound interest does and still spend reactively because knowledge and behavior operate through different systems. The people who benefit most from financial education are people who convert that education into structural changes to their financial environment, who automate, who pre-commit, who design their systems so that the right behavior is the default rather than the override. The people who consume financial content without changing their systems tend to feel more informed about the decisions they are still making the same way. There is a version of financial literacy that makes you more comfortable with the status quo by giving you a vocabulary for it. That version is not financially useful. It is emotionally comforting. There is a meaningful difference. So what is the small daily decision that actually separates the two people? It is not the coffee, not the lunch, not any specific spending category that the personal finance industry has spent decades moralizing about. It is the prior decision, the meta decision, the choice about whether your financial life will be governed by a system you designed in advance or by the sum of reactive responses to a consumption environment designed by people with a direct financial interest in those responses being expensive. That decision is made or not made quietly, usually early in adult financial life when income is low enough that it feels premature to worry about, usually deferred because deferring is the path of least resistance, and the present always seems like the wrong moment to start. And then, not dramatically, not with any single identifiable turning point, the two trajectories diverge, slowly at first. Then, as compounding takes hold with increasing momentum in both directions. The person with the system is not richer by a little at 45. They are richer by a structural shift. The cushion changes every financial decision downstream. The absence of scarcity creates a different relationship to risk, to career choices, to negotiation, to opportunity. The person without the system is not poorer by a little. They are operating from a fundamentally different financial position, one where every decision is made under the quiet pressure of inadequate reserves. Here is what this story doesn't resolve, because honesty requires not resolving it. The meta decision, the choice to build a system rather than respond to an environment, is itself easier for some people than others. Someone with an unstable income cannot automate the same way someone with a salary can. Someone carrying $40,000 in student debt at 7% interest has a genuine mathematical question about whether saving or paying down debt is the prior commitment that matters most. Someone in a household where multiple people make financial decisions faces coordination challenges that a single decision maker does not. The structural solution is real, it works, the research is consistent and clear, but access to the solution, the ability to actually implement it without the immediate demands of financial stress consuming every available margin, is not equally distributed. The wealthy person who automates $500 a month into an index fund is making a decision whose long-term value is enormous. The person who has $500 left over after housing, transportation, food, and debt service is making a different calculation entirely. The advice is identical. The available options are not. So the small daily decision that separates the rich from everyone else is real, and the conditions that make it accessible are not equally real for everyone. The gap is behavioral, and it is structural at the same time, which means the conversation about why it persists and who bears responsibility for the conditions that make it persist is considerably more complicated than any personal finance framework is usually willing to acknowledge. You can design a better system for yourself today. That is true and worth doing. And it is also true that the environment you're designing against was not built by accident, has been optimized by significant capital and intelligence, and has a structural advantage over any individual's counter system that no amount of good intentions fully offsets. The daily decision is yours. The environment that makes the daily decision so difficult is not.